In Secure Act 1.0, it bumped that RMD age from 70 and a half till age 72. So really, we got another year and a half to potentially do more Roth conversions and things of that sort. Part of Secure Act 2.0, we also got an increased catch-up contribution. So as you get closer to retirement, you can contribute more to your qualified retirement accounts. The problem that we've seen with some clients, or potential problems that we'll see more down the line, is as that age gets pushed further out, the money has more time to compound. So for good savers, it might only make their tax problem worse. I think those auto escalations and auto-enrollment behaviorally have shown to be the best for people. Part-time employees now also have access to plans, so that was a new thing. You don't have to be a full-time employee to potentially qualify for those retirement plans like 401k plans through work. As some of these laws change over time, it will impact our plan in one way or another. Maybe good, maybe bad, but we need to adjust the total plan to make sure we're compensating for that.
Hello and welcome to The Relax. It's Retirement Podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell, and Josh loves to make fun of me when I'm doing the introduction, so thank you for that, Josh.
You're welcome. Yeah. I don't know if it'll be cut into the YouTube version of the podcast, but I was making faces. So,
making fun of me for smiling because I was told, you can tell in your voice if you have a smile on or if you don't. So I was just being professional, but if you would rather I not be professional, I can accommodate.
I would prefer that you're professional, Wendy.
I'm actually surprised by that.
Smiles and laughs are always good, though. We got to keep things positive. And,
Okay.
I find myself, like on long drives and stuff, you put on that music that gets you pumped up. Right. Wendy, here's the real quiz. What is that music for you?
Ooh, well,
Taylor
recently
Swift?
It's Taylor Swift. Yes.
Okay. Is there like a throwback, though?
I was a big 80s hair band girl, if that's what you're talking about.
Okay, so that's it? Yeah, okay. So mine is like early 2000s, like emo punk rock. So that was like,
geez.
I played in a band, and I don't know, like, recently I was like, it popped on like in my Apple, just frequently listen to it, like put on some Good Charlotte, and I was like really jamming. Like, gosh, I'm old. Like, this is old music now.
Yeah. So Good Charlotte, that's the anthem?
Yeah.
Love that song.
Yeah.
It's one of my
favorites. I know. It's good. Like, it gets you.
Yeah.
And then sometimes when I'm singing along to that music, I'm like, I'm almost 40 with kids. Like, I should not be so upset about my girlfriend dumping me, which hasn't happened, in like 15 years at this point.
You're listening to Good Charlotte talking about getting your dumped by your girlfriend when you're married with 2 kids?
A lot of that music is rooted, Anyways,
I understand. Are we going to have a topic today, or are we just going to like shoot the breeze?
Nope. We're talking about throwback music. Other than throwback music, there are other important things.
Okay.
I think in the news cycle this year has been a lot, right? We see a lot of proposed legal changes, then they are pulled back. We've been talking a lot as a team, and as we meet with clients, there's a lot of changes that are law that have changed over the last decade that a lot of folks preparing for or recently retired still aren't aware of. So I thought, what a great podcast topic. We'll kind of recap some of those changes to make sure you're up to date on things before you retire, or if you are retired, to make sure that you're complying with those current rules.
Rules. So sick of rules, but all right.
Well, we can call them laws. I think rules sounds a little bit better than laws, but
well, rules you can break. Laws you're not supposed to.
Fair enough. Yes, you aren't supposed to. That's true. Rules are meant to be broken, right?
Right. For those, rule breakers. I happen to never be a rule breaker. Right?
Yeah. Well, if you change the rules, then it's fine. So
yeah, exactly. All right, so let's get into it.
Yeah, I think, in general, I think to me, any legal changes present a planning opportunity, right? They're not always all bad, but as the rules change, we need to be able to adapt our plan, to adjust to that. So I think one of the big ones, one of the first major changes was Secure Act 1.0, as it's now called.
I don't like that there's a 1. That means there's another one, right?
There's a 2. Yeah. So Secure Act 1.0, this is in 2019, so right before COVID. If you remember that, that's like, 5,000 years ago now, right?
Yeah.
The whole life ago. But one of the things, and one of the big things that changed during that is RMD ages got pushed out. So RMDs forever were age 70 and a half. So you needed to start taking those required minimum distribution, a forced distribution from your IRAs, 401ks, your qualified retirement accounts, starting at age 70 and a half.
Regardless of whether you needed it or not.
That's right. And those forced distributions can cause planning problems if it's more than you need coming in. So one of the things that we like to do is early in retirement, look at things like Roth conversions and that kind of stuff. So in Secure Act 1.0, it bumped that RMD age from 70 and a half till age 72. So really, we got another year and a half to potentially do more Roth conversions and things of that sort. On the opposite side, if we're not planning ahead, Wendy, hey, that problem might continue to compound, right? We have another potential year and a half of growth. So again, a change there. It makes sense logically because people are now working longer than they ever have before. So, it kind of makes sense overall. Another thing in Secure Act 1.0 that was eliminated is what we used to refer to as the stretch IRA. If I were to inherit an account, let's say from my parents, I would be able to stretch out the distributions on that account over my lifetime. What changed with that is now I have 10 years to distribute that. So if we think in terms of taxes, if it's a shorter timeline distributing those funds, well, that can certainly get us in trouble if we're in a higher income state, right? We have to take more out in any given year. If we could stretch it out where it's a smaller amount, like 4 to 6% over our lifetime, we might not ever fully deplete that account. So we can minimize the tax impact. Well, guess what? That went away. Those are good things from the government perspective, right? Because we're able to raise more revenue via taxes in a shorter amount of time. So those were, a couple major changes. Another one that comes up in Secure Act 1.0 is contributions being allowed for traditional IRAs past age 70 and a half. Prior, we couldn't make any contributions to IRAs. So for those that are working later into retirement, especially if you're in a higher income bracket than you might be once you do retire, you still have that ability to contribute to an IRA to potentially lower your tax impact for that year. So that was Secure Act 1.0. And you know what we do with a 1.0, as you noted? We give it a 2.0, right?
Yeah.
So 2022, we had the update, and there we had a phase up of the RMD age. So starting in 2023, RMDs now would start at age 73. So we went from 70 and a half to 72 on 1.0. 2.0, we start at age 73, and eventually it phases up to age 75 for those turning 75 in 2033 or later. So we phased it out even further. Part of Secure Act 2.0, we also got an increased catch-up contribution. So as you get closer to retirement, you can contribute more to your qualified retirement accounts, IRA, 401k, those sorts of accounts. So we were able to contribute more there for those that need to save a little bit more leading up to retirement. So again, kind of good, right? If we're in that boat that we need that.
Sure.
RMD ages getting pushed out further. Well, if you're still working, that might be good. Maybe more time for Roth conversions. I think the problem that we've seen with some clients, or potential problems that we'll see more down the line, is as that age gets pushed further out, the money has more time to compound. So for good savers, it might only make their tax problem worse.
Okay.
Yeah. One of the other pieces in Secure Act 2.0 is the ability to do Roth matching contributions. So traditionally in a 401k, if you have a Roth 401k option, any of the employer contributions would go to the traditional 401k. With the update, actually starting last year, you were able to start doing Roth matches there. So that opens up the flexibility in a 401k plan a little bit more. Need to look at your plan to know all the details of it and what's available in there. Another, which I think behavioral benefit there, is For new 401k plans, there is a tax incentive for auto-enrollment and auto-escalation, which behaviorally we know is the best thing for saving for retirement, right? So if you started a new job, you default into being enrolled in the 401k. Like our 401k here at the company, you default to the match. Our match is 6%. So if you join the company, you are auto-enrolled into that. It's going to withhold 6%, and the company is going to match 6%. So that's 12% of your earnings towards retirement. That's good. That will help you over the long term to reach your retirement goals. So if we think of that, some might say that that's over government control, right? We're forcing people to save. I think it's good because behaviorally, when we start a new job, we're worried about a lot of things. And especially when we're younger, when we have more time to let that money compound, it might not be our retirement plan, right? It might be getting adjusted to that new job.
Right. And then we're like, let's see where the bills, how they flesh out, and then I'll sign up for the 401k.
And then you blink and then you're 40 and, so yeah, I think that it is important. I think those auto escalations and auto enrollment behaviorally have shown to be the best for people. So the auto escalation is that it increases your savings a little bit each and every year. So you can set some parameters around that. So if we think of, hey, if we on average get a raise of 3% a year, maybe I want my 401k contributions to increase by 1% a year up to 15% or until whatever.
So
amount.
there is like a level that
you can set. Yep.
Okay.
And so these are default. We changed the default from no enrollment to auto enrollment, auto escalation. These are helpful because, again, by default, we are doing the best known behavior, so to speak.
Got it.
So those are good changes. By doing those, there's some tax incentive for employers as well. So that's a big bit there. I think other major changes, with those RMDs, as I kind of hinted at before, is the Roth conversions. I think increasingly we see folks with very large IRA, 401k balances. And as those accounts get higher in value, we might have those RMDs that are more. We want to be able to have tax flexibility in our plan, right? We want, ideally, not to avoid all taxes, right? Because in order to avoid all taxes, either we're doing something illegal or something wrong. So,
hey, just not following the rules. That's all we're doing.
Yeah. Well, there are penalties for that, Even took down some big, powerful Al Capone. I think tax compliance is very important, right? We need to make sure that we're following the rules there. However, with proper planning, we can look out over time and say, hey, Wendy, when you retire, come your RMD age of 75, you're going to have to take out $20,000 more a year than you need to spend, even if you go on tour with Taylor Swift. So in that scenario, great, then we should start doing something ahead of time now to control. If taxes are higher in the future, we want to be able to, have a little diversification in our taxable types within the portfolio as well.
Okay.
So we want to keep on that. With these rule changes, it kind of changes that structure there. So we need to update our tax plan.
Got it.
Wendy, another big thing that we've seen evolve over the last 10 years is Medicare IRMAA and that tax planning around Medicare. So Medicare surcharges, or IRMAA, is the increase in Medicare cost based on your income. So each and every year it updates, but if you're a higher income individual, you're going to pay more for Medicare. That comes in the additional costs of Part B and Part D, and that looks back 2 years ago at your income. So if we are transitioning into retirement with a large severance package, or we decide, hey, I'm retiring in November of this year and I'm taking a bunch of money out of my 401k because I'm going to buy a house in Florida or a warmer climate and I'm avoiding the winter up north, right?
Okay.
If that's the case, we might really hurt ourselves by bumping up into a higher tax bracket and then subsequently paying more 2 years down the line for Medicare. So we need to be careful with that. It's additional cost, that's going to impact your total retirement expenses. This falls into what we call the good saver tax problem, which we did a podcast on before. But this is the idea that with all of these compounding pieces of taxes, we get pushed into a higher tax bracket outside of our control. Similar to the RMD problem, Medicare and IRMAA causes us to have to spend more. So we want to look at that tax diversification. If we're taking some money out of Roth IRAs or non-taxable accounts, we're able to minimize our taxable income, which then keeps our cost of Medicare lower as well.
Okay, I was going to ask you, like, does that mean we can't get the house in the warmer climate? But no, you're saying that we might be able to just take bits and pieces from other, all around and to minimize that, potential penalty.
Exactly. If the intention is to retire at age 67 and be in Florida 3 months of the year, right? Let's look ahead of time and start putting enough money away, maybe in a Roth or a taxable brokerage account where we're keeping a lower capital gain in that account, or a savings account. I mean, currently we still have decent yield on CDs and high yield savings accounts. If we're able to earn 4% there, and we know that maybe in 3 years we're going to use that for a down payment on a house, that's certainly prudent. What we don't want to do is put it all in more risky investments in a fully taxable account, because if the market's down and tax rates go up, it's going to cost you a lot more to get where you want to be. So planning ahead and being intentional about that goal will help you eliminate the Hurricane Irma, as I often refer to it, because people are shocked. They get a letter in the mail and, hey, my Medicare costs went up.
Yeah.
You can appeal it. So we recently had a conversation with a client who is in that transition now. We had just met with them, so we didn't get to plan ahead enough, but they're going on to Medicare. And I said, hey, your income's not that high this year. There's a form you can fill out to protest that increase. Now, if you are consistently hitting those higher income thresholds, they're not going to give you a break, right? It's only if it's a one-time situation you can stand. So major life changes, we might be able to get an exception on that as well.
Okay, but don't count on it.
Don't count on it. Yeah, I think if we can plan ahead and avoid the potential pitfall, that's just a better situation.
Much better.
Yep. I think now leading up to retirement too, Wendy, we want to be looking ahead, making sure we're saving enough. With those higher cap limits for saving, we're able to potentially save more in our 401k and IRAs. We talked a little bit about that catch-up contribution, but now our limits are going to index over time too, so they will continue to increase. The IRA cap for the amount that we could contribute was locked for, I think it was like 20 plus years, so it wasn't increasing. If we think about everything else with inflation, we need more money, right? So we should be able to contribute more into those accounts. For independent contractors or those self-employed, unless you had another plan, that might be a limiting cap for how much people were saving. So by increasing those limits, we're able to potentially save more. If you have a 401k at work, it makes things easy, right? It kind of puts things on easy street if it's automatically deducted. If you have to write the check somehow, it is impossible, right?
Yes, it hurts so much more.
And Wendy, this is just good financial habits in general, right? If we make it a forced action, so even if it's adding to our savings account to have that cash bucket that we talk about.
Yeah.
Paycheck goes in on the 15th, on the 16th, we transfer blank dollars to savings, or set it up through your payroll system with your employer that it doesn't even go into your normal checking account. Part of it goes into a savings account, and then hopefully you don't see it as available funds.
All right. Sounds good.
So, I think those are good. Part-time employees now also have access to plans. So that was a new thing. You don't have to be a full-time employee to potentially qualify for those retirement plans like 401k plans through work. We've seen that as a trend for very large companies now for probably the last 15 years, where they are going to put people just below full-time status to potentially avoid having to pay those extra benefits. So this kind of balances things back out a little bit there.
Okay. They're being sneaky.
Yeah, well, it's a cost reduction, right? And if you are a company that part of your job is to also benefit shareholders, that lower cost is in theory, benefiting shareholders. So that's what they're going to try to do. So we need to balance that back out, right?
All right.
That's the system. I didn't do. So I think the biggest thing is, what do we need to do, right? There's a lot of changes right now. There's talks about Social Security changes, whether that is pushing out the age that you can claim or your full retirement age. We've also seen proposals to eliminate the taxation on Social Security. I would say at this point, don't get hung up on things that aren't laws, right? There's a lot of talk. We have a system. It has to go through the system to become law. So we don't see anything changing quickly. Typically, when these laws are enacted, there's a bit of time to make adjustments. So as laws are changed, we need to readdress and update the plan. This is something that if you're on our email list or regularly listen to the podcast, we will certainly talk about those laws as they are enacted. But don't get caught up on all the what ifs, right? Once it's enacted, we typically have some time, whether it's through the end of the year or maybe a year or two out, to make some of those changes. You want to make sure that you're adjusting the plan ongoing. If you listen to the podcast today and you say, hey, I didn't even know that my RMD got pushed out from 70 and a half, let's look at restructuring your tax plan to make sure it's matching there. We don't want to say, hey, oh, cool, I don't have to take out the money, and then we're running into that good saver tax problem in the long run.
Right. Let's just not worry about it till 73.
Yep. Yeah, right? I mean, that's the best with everything. If we ignore it, it gets better, right?
I can tell you from experience, that doesn't work.
It doesn't,
no. And yet I still continue to count on it. Work.
Yeah. Yes. At times, and I think sometimes that's the benefit of having a partner. So whether it's a spouse, financial advisor, accountant, legal professional, sometimes it's that other person to hold you accountable to yourself, right? You might intend to do something, and well, that was like 2 or 3 years ago, and now it's overdue and you've complicated the problem there. Many times we don't want to do things that we know are going to be painful, whether that is, trying to save more, reduce short-term spending, those kind of things. At least knowing the impact and regularly sitting down and saying, yes, okay, I didn't just bury my head in the sand, right? This is something that either I'm intentionally foregoing for some reason at this point. Mm-hmm. I think my exercise has gone down through our moving, Wendy. Ugh. When I have that big goal of doing Leadville, the bike race, I'm very committed to my regular training. When I'm moving and I'm driving a lot and I have a lot of other personal stuff, it's hard to set that time aside.
Yes.
While still, trying to be good husband, father, all that stuff.
Was any of your New Year goals athletic directed? Because it doesn't look like we're going. It doesn't look. Like
I was 2 local races, Wendy, which I'm not. No. I'm not gonna. It's not gonna happen. I am. I'm haven't officially signed up, but I'm trying to do a 60-mile mountain bike race in Austin in the fall.
Oh, nice!
So I just started training again, 5 days a week, trying to be on the bike. It's painful when you stop for a little bit. It's funny how that works, One
of the reasons, it is worse to stop and restart than to just keep going.
It is. Yep. And I think to me, like after Leadville, it's a big event, so you don't want to give your body some time to recoup after.
Right. Yes. Exactly.
If there's not the next target set, that time gets to be too long, and 30 pounds later, it's a little bit harder to get pedaling.
Wow.
30 pounds. Yeah, that's 30. Yeah.
Hey, I'm sure that you carry it well.
Thank you. I carry it really well sitting, Wendy, with the camera from here up. I carry it fantastic.
Well, I had been injured in January, and I wasn't able to really even walk for like 2.5 months.
No pickleball?
No, it was a workout.
Okay.
That caused the injury, and then I couldn't play pickleball. I couldn't continue in my workout, and like you were saying, I actually just got a notification from my phone telling me your activity level has increased in the last few weeks. Well, yeah, because now I can do it.
Yeah.
So even your watch and your phone will yell at you.
They like, do.
Your activity has decreased.
Our new yard is quite a bit larger, and at least for the time being, I'm committed to push mowing. the half acre. You get a lot of steps in push mowing a half
Do
acre.
you?
You know, it's weird.
and
Our
sweaty.
previous house was more of a city house, so like a really, took like 20 minutes to cut the whole thing. So
Okay.
this is more of an adventure, so that's been a little bit more exercise.
Yeah.
Yana was very happy with me that the day prior to us packing up the final load from the Michigan house, I was at a kid's birthday party, and there was this obstacle course bounce house.
Oh no.
Well, I beat my oldest son racing through the obstacle course, and then about 10 minutes later, I'm like, my back really hurts, and I'm too old without exercising to fling my body through a bounce house.
Well, as long
Go
as
figure.
you won, I mean, that's really all that matters.
That was my mindset at the time, but the next morning when I had to load stuff, I did not feel that way. And
Live and learn, Josh. This is how
I'm
we
not,
live
but
and learn.
I'm not learning. I'm not quite ready to give up on competing at kids' birthday parties. Apparently, I need to stick in there, Wendy. So I need to do some more core exercises.
Well, I mean, and you can increase, your ability to do these things. But I always say that, unless you're going on this, huge training regimen, that you're likely at the best health and physical, shape that you're ever going to be in. So take all advantage of it now.
I'm going to. Yeah. I from what I hear, you only get older every day.
It's inevitable. All right, back to the show.
Back to the show. I don't know, maybe that is the show, Wendy. Who knows? But, much like we talked about with exercising there, right? We need to be prudent. We need to update the plan over time. If we injure ourselves at a kid's birthday party, it might set back our training schedule. But to safely get back to playing pickleball, bike riding, whatever it might be, we need to do that, just like retirement planning. As some of these laws change over time, it will impact our plan in one way or another. Maybe good, maybe bad. But we need to adjust the total plan to make sure we're compensating for that.
Okay. So, update. Keep it in mind. Review, update, review, update.
Review, update, and then the next time you need to review and update again, right?
That's what I said.
It's good. Much like looking at, your general portfolio, look at it a couple times a year, right? Review this. We don't need to have a gut reaction every time there's bad news and throw the whole plan in the garbage, but we do need to adjust a little bit over time. If you're not already working with a financial advisor, financial planner, if you don't have that financial professional or trusted partner on your side, we'd be happy to have a conversation with you, see how maybe some of these tax and law changes over the last 10 years have impacted your plan, and update that plan for you. By taking that long-term approach to planning, we're able to retire with intent and help see our goals forward. If we stick in the same boat, keep making the same mistakes, things are not going to get any better. So we need to plan ahead. Check out our website. Sign up for a 15-minute phone call in the show notes. Make sure that you're subscribed. If you haven't already subscribed to the podcast, make sure to do so. Until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.